Welcome to episode 78 of Accessible Finance. Let's dive in.
All right, Eric, today's scenario is I have been a diligent saver. Most of my money is in pre-tax accounts like a 401k or traditional IRA. But now I'm starting to get worried about the tax bill when I retire. How can I manage this? So where should somebody in this position even begin?
Immediately convert all of it to a Roth. I'm just kidding. Don't do that. That's terrible. That's funny though, right? I mean, it's only funny if you're a planner. You understand what that means. That would just mean paying a lot of taxes that you probably don't need to pay. So
we've seen that though.
Correct. You want to consider, right, your tax brackets over time and what the fact that you have all of your savings or a majority of your savings in tax deferred accounts would look like over that time frame. And what I mean by that is when it's time for RMDs, what do you project your balances to be, right? If we assume some modest growth rate, assume maybe a 5 or 6% growth rate, that's pretty reasonably conservative. Depends on how it's invested, right? But we can think about a 6% discount rate and start to extrapolate that out and then try to find out what your RMD is going to look like. And if you're comfortable with that and that tax situation, and the reality is you're probably not going to enjoy that too much, and you're going to want to consider what we would call a Roth conversion ladder, which means you're going to want to manipulate your income. And by manipulate, we mean in this case, we'd be raising our taxable income in the years between retirement and RMDs.
And I want to touch on what you're saying here, because when we say manipulate, we're not talking about doing anything shady or illegal or anything like that.
Correct.
But it's timing when you're realizing that income and recognizing it for your tax purposes, right?
Right. The IRS says that we can practice tax avoidance, but not tax evasion. So the idea is we can try to pay as few taxes as we can using the IRS rule of law, right?
Yep.
But we cannot try not to pay taxes that we owe. Okay, so there's a line there, right? We can use legal means to try to minimize taxes, and these are tools that they've given us.
You should
Correct.
be using them.
You ought to be trying to do this kind of tax planning.
Exactly, and that's the whole idea behind withdrawal strategies and tax planning at its core, right? So you've touched on one of the major tax risks that somebody who has saved a lot in tax deferred would be hitting, right? We'd be remiss if we weren't saying like, great job on saving, right? That's already,
absolutely.
So you've saved, you've done a great thing. And it can be so disheartening, I think, for somebody who's worked so hard and has saved for so long to realize that they may not have diversified in the 3 buckets that we spoke about in a previous episode, or that they feel that they may have suboptimally, placed those funds. All hope is not lost, right? There are things to do. And so the first of the major tax risks, wow, that is a tongue twister for me. Tax
risks? It is kind of hard.
Say it again.
Tax risks.
Okay, I'm just going to say it.
I won. I think I've won.
I think you did too.
I'm really proud of myself, guys.
I'm really disappointed in mine.
That's fine.
But I think that you touched on the very first one, which is RMDs, right? So can you speak a bit to how that is a risk, and then what steps we may be able to do to minimize that risk?
What will happen is your bracket will start to creep up. So RMDs increase over time. They start around 6%, and then they'll get as high as 50% as you're over 100 of your account balance, right? So does that make sense?
Yeah.
So what we want to do, the way we want to think about it, is we want to keep a
tax risks.
Yeah,
I won.
exactly. Yeah. Touche. Well played.
Thank you.
We want to try to keep our effective marginal effective tax rate relatively equal over time. And the reason I transpose those words, I've talked about it before, and I know I talked about it on the last episode.
Yeah.
But the point is that we're trying to fill up the smaller buckets, right? Or I say smaller, the lower rate buckets. Like, we don't want any year to pass where we don't pay a single dollar of tax at 10%, okay, or 12%.
So to make
just as a general
where's your
heuristic,
threshold?
general rule, I would say always fill up the 10% bracket, always fill up the 12% bracket. To the extent that you're not, you probably paid too much in the past, or you're wrong, because you will be paying more in the future, right? Those are very low brackets, super low hanging fruit. They should always be filled. Okay. So our point is we want to fill up the lower brackets. That's how we're trying to think about this. And RMDs are going to make it to where whatever bracket we're at today, we could potentially be going much higher in the future because the RMDs are going to increase over time. And then our tax account balances could potentially increase over time.
Yep.
We might have Social Security that's going to be increasing over time, right? Like there are and then the earnings on the accounts themselves. So we talked about RMDs increasing over time. What we mean is they take a larger percentage of the total December 31st prior year balance of all of your tax deferred accounts. And they say you must withdraw this percentage. And that percentage goes up. It goes from 6 to 12, it goes up over time.
Yeah.
6, 7, 8, 9, whatever, it climbs. Okay. So that percentage is going up. But also typically if these accounts are invested, then they will have to, then they'll grow. Right? Like you'll have some rate of return on these investments, and that's going to be going up over. So the balance is going up, and the percentage that you have to withdraw is going up. So these RMDs could potentially put you in higher brackets over time, and that's what we're referring to when we talk about, your tax bracket creep over time.
Yeah, perfect. Exactly. So, the RMDs kind of cause this tax bracket creep, right, to happen. And then in addition, one of the downfalls that we talked about or the cons that we talked about to that tax deferred account is the fact that every withdrawal that you make
Ordinary income.
Correct.
No exceptions.
Correct. And so you leave yourself with very minimal flexibility here.
Couple exceptions.
Oh, well.
QCDs, right? So I guess technically it's not you withdrawing the amounts, but you can write a check essentially straight to charity from the account called a qualified charitable distribution if you're 70 and 1/2 or older. So age 70 and 1/2 or older. Because they didn't change the law. It's is that interesting to you? Because it's interesting to me.
Well,
they updated Secure Act and Secure Act 2.0.
I find it fascinating
Increased
that
RMDs.
We like to live
not QCD age.
in ages that are half years,
it's fun,
and it's. I mean, if you feel like the tax.
Yeah, it wasn't complicated enough. Let's start using fractions. That's going to help everything. That makes it all more clear.
So yes, please know you're not alone in being like, what the heck is all of this?
Right. So if you are charitably inclined, QCDs can help with this a little bit.
But again,
only to the extent of $103,000 a year. Oh man, it's another number that I haven't memorized, but it's per person, and I believe it's around 103 grand. I think it started with Secure Act and it's indexed to inflation. It's 2025.
Okay, all right. Did they go down?
No, I'm just wrong. It's 108. I was wrong. It's 108,000, not 103. Sorry, guys.
Maybe 2023 was.
It's rough. It's brutal.
Was 103.
I failed us. But anyway, yeah. So you can write a QCD
risks.
from the account.
I'm gonna get it.
That's pretty funny.
Okay.
Well played. Well played.
All right. So, okay. If somebody's coming to us again in this situation saying, look, like I've saved my whole life. I have everything in my tax deferred account. It's what my job place told me to do. And to be honest, that is literally like the majority of people are just kind of deferring and putting stuff in their 401k and calling it a day.
Right.
And
that's what your employer's matching.
Yes,
that's what you've heard about the most.
Well, and
most
a lot
aren't going
of
to really
times,
push the Roth options that much. Some 401ks don't even have
offer.
it.
Yeah, I was going to say a lot won't offer them. I will say I do think that's starting to become more common, but it's not even something that, like, I will tell you, when we had our benefits people come, that was not what they felt comfortable talking about, right? Like they're going to talk and push the things that they know. And a lot of times people who are participating in a workplace 401k believe that they're working with a financial planner because they have a guy who told them that the target date fund is the best fund for them and that they're done.
Ooh, we're going to get to go on a little tirade about the planning industry or the finance industry?
It could be a caveat.
Definitely not the planning industry.
But
I wouldn't call it that.
No, but I mean, we've had a number of people come to us tell us that they're working with somebody because there's a finance guy that will come and talk to them annually at their job.
Correct.
But I will say this is not somebody who's going to help you figure out your withdrawal strategy or figure out your tax planning when it comes time for your RMDs and things like that. So all planning is not equal. Investment management is
correct. Their job is to increase deferrals so that there's larger AUM that they get to collect on.
Yeah.
That's the answer.
Well done. Okay. So we've talked about kind of those the traps or the hidden things that are there that can come to fruition if you only have funds or money in tax deferred accounts. So what is something that they can do now to reduce the future taxes. You've already kind of spoken to some of those, but I think kind of tying it with a bow would be really well.
Yeah. So what we're trying to do is we're trying to increase our tax brackets today, our taxable income today, in an effort to decrease it in the future. So when we convert, like when we execute Roth conversions, what we're doing is we're converting the tax deferred balance to a tax-free balance and paying tax on the amount that was converted.
So for example, right. So for example, I have, I don't know, 500,000 in my tax deferred account.
Okay.
I know RMDs are going to happen down the line, right? So they're going to tell me that I need to take like 16% of that 500,000, right?
6% in the first year, yeah. Something like that.
6. I thought it was 16.
No, it doesn't start at 16. That'd be really high.
It was high. I thought that's what you said. Well, okay, 6%, right? So I end up having to realize a significant amount of money, right?
Sure.
Okay, so I'm having to
You racing me
take
to the life expectancy
30,000.
table?
No, you can. You life expectancy all day long.
Oh, you're talking about the divisor. I was talking about the percentage.
Oh, well, there we go.
Sorry. Yeah, it is 16.4 at age 73. However, that's the divisor. You divide that account by that, which is about 6%.
Okay, so then I'll say I'll take about, like I had $500,000. I'm going to take about 30,000 then, right? Yeah.
Sure.
Okay. So I'm taking 30,000. So I'm recognizing 30,000 of income. I now have to pay whatever my tax bracket would be in that, right? But then my next year, it's not going to be 30,000, right? My account has gone down by 30,000, but that's not a huge amount for
Correct.
$500,000.
Correct.
Right? So it goes up from 6% to something else.
Right. Higher.
Right? And so it'll continue to go up and up and up. And so I'm soon starting to realize like numbers that are, 100,000.
Right.
And so I'm now in a significantly higher bracket.
And frankly, the balances are going to be higher than that, or we would say don't retire. Like if you only have $500,000 in a tax deferred account, you're probably not retiring.
Fair. I picked it just for ease of numbers.
Sure.
But yeah, we're probably, you're talking something million north, right? So
Yeah.
you're talking large numbers.
Right.
And the reality is that if I have the opportunity to start taking some of that million that's in that pot and say, okay, I'm going to start instead of you telling me that I have to take 100,000.
Right. That's the idea.
I'm telling myself I'm going to take this much. I'm going to pay taxes on this much. And so then even when the RMDs kick in and they're giving me, I need to withdraw 6%, I'm not withdrawing 6% on $1 million. I reduced $1 million because I started realizing things earlier.
Correct. And then a couple caveats that we talk about a lot when we're talking about Roth conversion ladders and retirement. The IRMA brackets, or also known as the Medicare premiums, the additional Medicare premiums that you will incur when your modified adjusted gross income exceeds thresholds, right? Those are things that we want to plan for. And so you would rather, all else equal, you'd rather have higher income when you're younger or lower than 65, really lower than 63 because there's a 2-year look back on Medicare. On the IRMA provisions in Medicare, within Medicare, right? So
complicated.
I know it is complicated, but the idea is we'd rather realize more income when we're younger than older, and we'd rather try to get some of this money out of. We want to get some of the money out of the tax deferred account. You'll hear people talk about it, like the tax time bomb, right? There's clever and little phrasing for it, but it will, if you have multiple millions of dollars in a tax deferred account, it can potentially blow you up, right?
Yeah.
Or you're going to have a large tax liability associated with that if and when you live long enough, right? So you want to try to think about reducing your tax bracket later by converting the money, right? So like Rachel talked about, if you have a large tax deferred balance, you convert some of that balance, it now grows tax free and you never have to pay tax again, okay? You've hopefully boosted your tax bracket, or you're paying taxes and filling the lower buckets. Right,
like
so
we talked about,
filling
the 10%,
10%, you're filling the 12%, you might be filling the 22 or 24. And then later, you might not have to pay any taxes at 32, 37, right?
Exactly. And I think, it's something like Eric had mentioned that you can kind of math out. It's also a situation, I think, where diversification as soon as possible is going to be very, very important. If you are currently tied up completely in your tax deferred accounts, you're looking to really start filling up that tax-free bucket. And so you want to keep that income as artificially low as possible so you can get more conversions. And so that would factor in with a delay of Social Security.
One point I'd like to make there is while we talk about if you're in your earning years and your tax deferred account is the only account, let's assume you don't even have a Roth account yet.
Yeah.
Okay. You don't even have it. You just have a taxable and you have a tax deferred, right? And you're in the 37% tax bracket. You're earning, $750,000 a year or something. You're earning lots of money. Okay. We might still say, keep pumping the tax deferred bracket. Okay. We might say that, but there's going to be a plan. There's going to be an exit strategy where we're not just going to have $10 million plus in a tax deferred account waiting to just kick out RMDs of, 400,000 plus.
That's a great
Does that make sense? So like there might be a world where we're completely content to still put money in the tax deferred while pursuing something like, hey, we're going to keep stuffing our taxable account because we know we're going to retire at age 50. And that gives us, 25 years potentially of Roth conversions. Mm-hmm. So we're going to carefully calibrate how we're going to get this $10 million of tax deferred savings out of there. So we're not we're still happy to pay less taxes at 37%, but we want to have some kind of a viable strategy as to how we're going to not pay in 37% forever in perpetuity and pay in the 37% with more dollars. Does that make sense?
Well, and I think that's the biggest thing here is that it's really easy to think of the financial planning process as, okay, I'm retiring. This is my change in life. I just need you to help me over this hump, right? When in reality, it is a complete lifestyle planning process, and it can begin as soon as people are willing and able to begin the process. I mean, we have plans with clients who are, in their 20s and 30s. Mm-hmm. We have plans with clients who are widowed and have been retired for quite some time. But the planning process doesn't ever stop, right? So as involved and proactive as you can be on the front end, it can set you up for making really great decisions now so that you're not in a position where you find yourself with everything in your tax deferred accounts. Right.
We would say if you do have substantial balances in tax deferred accounts, you probably do want to start thinking about, we talked, in prior episodes about how long till you should maybe think about, working with an advisor or potentially like a planner. I like to make the distinction because typically advisors are going to tell you where to put your money.
Yeah.
Right. I think of advisors as we're going to just tell you where to put your money and that's it. Right. And then we say, good luck.
I tell you what buttons to
push. You say I need 100,000. I say, here's what we're going to sell. And now here's your 100,000. Right.
Yeah.
I look at that to me is myopic. It's too small. Right. We want to be broader than that. We want to be doing tax planning. Do you?
I do.
Good. Thank you.
I do.
But the point is, I think about 5 years is probably the minimum. To work before retiring, because you're going to need to accumulate taxable account balances so that you can A, live on them, and B, execute conversions probably during that time frame. But also, if you're retiring at 50, you probably need a pretty solid plan because you're going to have a long time to be drawing on your portfolio before Social Security kicks in. So we need to really calibrate your spending and make sure and see what that looks like in different environments.
I mean, the planning on RMDs and Social Security alone mandates, I think, almost a 5-year window there to plan that withdrawal strategy.
Particularly if you're just stuffing it in tax deferred and your taxable balances are not particularly high, or just we don't know how much we're going to have to convert, and it could be a significant amount of taxes, right? If the stars align for you and you're really interested in, like estate planning, you have considerations where you want your beneficiaries to inherit Roth accounts, you think they're going to be high earners too, so you don't want to stick them with $10 million of tax deferred income that they're going to have to dump within 10 years under current rules.
And that's what's so interesting. There's so many things that are triggered without us without the general public, right? Even knowing that they exist. Mm-hmm. And so being able to even just have a thought partner and talk with somebody about hey, this is my current situation. Lay out my options for me. Right. Just to even know what they are.
Right.
It's overwhelming. And I will tell you right now, if you're looking on ChatGPT or AI stuff, it's just wrong. It's wrong a lot. And to be quite frank, the changes in laws and all of that stuff as well, it's so hard for people to keep up with, for AI to keep up with.
They still thought that there were RMDs from Roth 401ks.
Yes, exactly.
Not true.
Well, and that's the thing. So it can be really, really easy in this day and age to feel like we can know all the things.
Right.
I mean, I'm totally guilty of going on WebMD and stuff to try and self-diagnose.
Absolutely.
I'm totally that person.
Everybody does it.
Right. It's really dangerous to do that with your money. So just throwing that out there. So, okay.
But yeah, if you're looking for broad takeaways, you're looking to, and you have a huge tax deferred balance, we know that the RMDs are going to be unsettling. And we know that when we withdraw that money, we're going to have ordinary income tax consequences on all of the money that we need to pull out, right? So to avoid situations where you're pulling out money and paying tax and then pulling out more money so that you can pay the tax on the money that you pulled out and then paying the tax on the tax. And it's unpleasant.
Dog chasing a tail.
Right. To avoid those kinds of situations, you want to have a strategy, right? So likely you're going to be trying to increase your, you're trying to decrease your tax deferred balances by realizing that income a little earlier. You're going to pull forward some of that taxable income in the form of Roth conversions usually.
So you're looking to pay a little bit of taxes now to avoid paying a lot of bit of taxes later.
That's exactly right.
Okay. And again, those brackets that we're really looking to fill are, 10,
10 and 12, I think, absolutely should be filled almost.
And depending on your situation,
it's very rare.
It may
I'm sure
be
there's some
higher.
cute situation that somebody could contrive that might not be true, but almost always. I've yet to see a 10 or 12% tax bracket that we weren't super happy to fill.
Yeah, exactly.
Right?
I love it. All right. So big takeaway for today is that your tax deferred account's great to save in, but you need to be planning your withdrawals. You need to be diversifying in those 3 buckets.
Correct.
All right.
Thanks, guys.
If you're sitting on a mountain of pre-tax savings or want a personalized tax strategy, we'd love to help. Please email us at podcast@equilibriumfp.com if you have any questions or suggestions.
Thanks, guys.
Till next time. What was it? Tax risks.
Tax risks.
Got it.
I did it.